Well, thank you to Diego and to QED for having me here today. My name is Julie Winkler, and I'm the Senior Managing Director of the Research and Product Development Group at CME Group. I started my career on the regulatory side, and one of the things that I did in my first job at the exchange was trade practice investigation. And so I was very much aware of the conflicts of interest that would occur among the members of our trading pits. And so it's interesting now, many years later in my job, still the regulatory side of things is critically important to the product design that we design, because we are a highly regulated exchange, as well as, not wanting that regulation to deter us from creating new benchmarks and new products that really fit the risk management needs of our customers. So it's a very fine balance that we have as market operators, and one that makes it pretty central to this debate as well. We've heard really all afternoon about the complexity of commodity markets, the fact that they're very dynamic and complex. And it's because of this complexity that I think is really kind of what we're all struggling with, is what's the best way to ensure that we continue to have the safety and soundness over these financial markets that's necessary around commodity benchmarks, but also is continuing to contribute to the price formation, the price discovery process, which really is the whole purpose of markets in general. So while we need to be careful that we are strengthening that regulatory framework, we need to do it and be mindful that physical markets, financial markets that are based on commodity markets, are very different and require a different set of regulation. CME Group has been actively engaging on this topic, both with the G20, with IOSCO, both with the national authorities as well, and we think this is a critical piece that we will continue to be involved in, as well as all of the recent UK initiatives that have been going on in this space. So before I go into more detail, I just want to provide a little bit of overview. On CME Group, so you can understand a little bit better of kind of our perspective and kind of how we touch on as market operators a number of these different areas that we've talked about today. CME Group is one of the leading and most diverse derivatives exchanges in the world, and so many of the products that we list on our exchange are used in commodity pricing around the globe. So things like the Chicago Board of Trade's corn, wheat, soybean oil contracts, the NYMEX crude oil, WTI, natural gas, heating oil, gasoline, as well as our metals complex. So gold, silver, and copper are all part of the benchmark commodity products that we list financial derivatives on today. While these are all operated in a group of core U.S.-based derivatives exchanges that are regulated by the CFTC, we also have asset classes, in the financial space as well, the S&P 500, interest rate complex, and even things as diverse as weather and real estate as well. As a basis of all of these products that we list, there's about 200,000 prices that CME puts out on a daily basis that are based on those futures and option contracts and are those settlement prices that we create. And again, those are primarily based from people transacting on our platforms or on our trading floor and really contributing to that price discovery. The other role that we play is also as a consumer of these prices from many of the price reporting agencies in this room. And so in that sense, we will list financial derivatives that are based on assessments that they are doing in the marketplace. We now probably have over 1,000 of those products that are listed on our exchanges today. And those sometimes are cleared transactions only, so they are bilaterally negotiated between two counterparties. And that final assessment price is again based back on what that price reporting agency has determined on that particular day. So all in all, our products, to the point that's been made throughout the day, are very global in nature. We're reaching over 150 countries today with our products, and we have additionally another 10 strategic partnerships with other exchanges across the globe that continue to offer and advance, I'd say, financial benchmarks and commodity benchmarks around the world. About 25% of our business today is traded electronically overseas. Most of that is coming from Europe today. The EMEA region is one of the most developed examples of our international growth, both in terms of our core markets as well as utilizing a lot more of the London infrastructure that we've been busy building over the last few years. So in the UK currently we're operating a CCP that's offering clearing services for over 200 different commodity products, including energy and ags, as well as a futures exchange that's offering FX and energy products, as well as a trade repository. So we are definitely a regulated European entity that is offering a variety of services today. We've also recently expanded our European benchmark business by partnering with Thomson Reuters to serve as the calculation agent for the new LBMA silver price, and also in the process of participating in the selection process for the gold price as well. So that is another aspect where we are serving as a calculation agent. So as I think too just about the commodity regulation specifically, if you can advance that for me. There's a number of key points, and many of them we've heard today. The whole fact about one size does not fit all, and I think I've heard that at least 4 times, but I think we have to say it 5 before we can get out the door tonight, so I will say it one more time. But by the sheer nature of the diversity of the commodity markets, it's just a fact that those individual contract markets have different fundamentals behind them, and they need to operate differently. And in that, it is just not going to work that we would try to copy and paste financial regulation and apply it to commodity markets. It simply is not going to work. I'd also say that, commodity markets are just particularly sensitive to overregulation. So we heard from Dave earlier, and I'll stress again, those voluntary submissions that market participants are making are indeed very voluntary. And it would very much be a concern of ours as a market operator to start to see those very key, global contributors to start to pull back from those benchmarks and make them less reliable, and probably will lead us to have to delist those products and make those risk management tools unavailable to the global marketplace. That is going to have, severe implications all the way down to retail consumers when people are not able to hedge their price risk further up the supply chain. So I just don't want to, minimize that fact that there will be downstream implications if things get overregulated. I think also, as we've said today, just because there's transaction data available does not mean that it's the best data possible. We work closely with the PRAs to understand both the methodology that they use in putting these assessments together, and understand the nature of the market color and the relationships that they're building to make sure that the prices that they are obtaining are from credible sources. And that is something that they regularly review, and something that we also share from a regulatory perspective with our market regulation area, so that we understand there is significant contribution being made to those benchmarks, and it's being made by people that are credible to be making bids and offers and submitting transactions in that space. And so I think in that end, we want to make sure that this regulation does not go so far as to create disincentive for those people to participate, because those price formation processes are just so critical to all of these commodity markets and to properly functioning derivative markets as well. And on the, kind of the last point of just the scope, I think we are mindful too that benchmark regulation is important, but it also should not encroach on the way that the physical markets operate today or the way that the futures markets operated. We operate in a highly regulated market today, and there's not a need to apply yet another different piece of regulation on top of that. Specifically for some of the products that we introduce as well, we want to make sure that things like central bank marks that are done outside of the European Union, as well as, approved statistical authorities, that those are things that are going to be exempt from this regulation. Because again, I think we would all feel comfortable in this room that the Federal Reserve of the United States of America is publishing a market that we can rely on. And having derivatives not be available on marks like that to European participants would have a big detrimental impact. And lastly, we've talked a lot today about just the cross-border challenges. I wish that I had the answer to what is going to solve these equivalency challenges, but I'm afraid I don't have that. What I can say is that, as we look at what is out there today, and we've heard some mention of, other countries and their pending legislation, we need to be honest with ourselves, that is not by any means going to be equivalent legislation. If you listen to the list that was rattled off earlier, the U.S. is not considering any additional legislation in this regard. And for the U.S. to go back and to modify Dodd-Frank is going to take another act of Congress to do so. From all of the folks that we speak with, that seems highly unlikely. And so if we're sitting here drafting legislation thinking that this is going to be a temporary solution until those equivalent regimes have legislation in place, that is just not a realistic assumption that we can be making at this point in time. I think the other piece is, I think I strongly agree with the point from earlier around the idea of conflicts of interest and where we need to really focus this legislation at. I think addressing those types of issues are going to be far more important than trying to think we're going to solve all of the issues around benchmarks. We have particular experience with the challenges of, let's even say or suppose that those equivalent regimes do come into place. Even in the case of CCP's equivalency between the EU and the U.S. right now, we've seen that even having equivalent-based legislation out there does not make it easy for these issues to be worked out, and we have personal experience from that. And that is even a case where there is legislation to point to. In the case of benchmarks, that, as I said earlier, is unlikely to be created. So we're going to, take a pretty strong view and caution against a strict equivalency approach. We just don't think that is going to likely exist in the future and is not one that's going to benefit the industry. And so we would hope that we can begin to make some progress on, I think, drafting legislation that can highly leverage what's been done with IOSCO. We are strong proponents of that process and have seen that it's added to the transparency. It's created certainly much more robust methodologies that we've been able to rely on as market operators as well as the market. So we think that that's a good path to go down and one to leverage that we would hope people would take into account as we look forward and get some more consistent regulation in place. Thank you.